What is going on? Welcome to my channel. I am the Covered Call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income. I am currently holding 6 Covered Call ETFs. I do portfolio review of all of my holdings, portfolio size, buys, sells, cash holdings at the end of every month. So stay tuned for that. My current annual dividend income is about $70,000 a year. It's 5.8K a month, 1.3K a week, $191 a day, and $7.99 per hour. Legal disclaimer before we start, though: this content is for informational, educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete, or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, we're going to just be talking about the difference between distribution and dividends and why some of us prefer distributions over dividends. I'm going to make my case why your dividend stocks are probably failing. And this is a huge debate. A lot of people do think of dividends stocks as, especially choosing Dividend Kings and Dividend Aristocrats. But I'd rather go with right now. I'd rather build up my option strategy. I buy instead to buy and to print income daily using distributions. All right, totally different. We're gonna be evaluating Covered Call ETFs versus traditional corporate dividends. All right, so let's look at how the $1 trillion wealth shifted, right? The old way, I would say, is broken. This was pandemic, where inflation pretty much crushed traditional fixed income and blue chip dividend portfolios, right? If you're yielding anywhere from 1 to 3, maybe even 4%, you're absolutely getting destroyed, especially if they don't have amazing dividend growth, right? And this led to the derivative explosion, where this is us income investors doing distributions, right? Investors flooded Covered Call ETFs, so the category surged from 300 million to 67 billion assets under management. The money inflow was crazy. Right, these are pretty much the new kings, right? Like JEPQ, Neos, right? Amplified. They took over the scene. Now, we do have to ask ourselves, are these massive distributions structurally superior and more reliable long-term than traditional corporate dividends? Yes, we do follow the money, but we are putting old-school dividend head-to-head with modern derivative yield. So that's one thing we do have to ask ourselves is yes, a lot of money is flowing in, but are they long-term holds? All right, let's look back at the truth of dividends, okay? It is at a board discretion. A lot of people don't mention it, but dividends are leftovers, right? Board pay you only after funding growth and debt. Historical shift. Dividends used to generate 31% of returns, right? Today, that math is pretty much dead. And then third is the crushed yield, right? Corporate buybacks replaced payouts, right? So the average S&P 500 yields are now a pathetic 1.2%. Now, I don't know about you. Sure, you can live on 1.2% if you have a $3 million portfolio. Okay, that makes sense. You have a $4 million portfolio. Sure, you can live off of that. And so this leads to at least my take on the fatal flaw is that dividends are lagging indicators relying entirely on peak economic expansion. Right. My statement here is that your dividends are controlled by stress executive protecting balance sheets. And let's look at the aristocrats too, right? Oh, always buy aristocrats, always buy Dividend Kings. Well, kings fall too, all right? Let's looking at the recession trap. When the economy tanks, profit margin shrinks, right? Payout ratio instantly spike. Companies pretty much will have to freeze or cut your dividends to preserve their liquidity, right? So you already faced a risk here. Your cash flow being completely wiped out, right? Dividend pauses, right? Or a dividend cut of 50% or just more, right? Let's look at the fallen kings of 2023 to 2024, right? Even 50-year streak failed during the several macro shocks. Walgreens, 3M, right? VF Corp, right? All of these lost they're 50-plus-year dividend king crowns and dividend aristocrats, right? Even 50-year dividend kings can and will slash your paychecks to save themselves. Don't think just because they've been paying for 50 years that they're safe. They're not. That's typically the biggest argument, right? Let's look at the buy right code using Coca-Cola as an example, because Coca-Cola pretty much prints, right? So how does Covered Call ETFs manufacture yield organically? Right, you can do it yourself. Essentially, they're doing it themselves. You don't have to wait on a CEO to give permission to make those dividend payouts, right? So essentially how does it work for us distributions? One, you buy the assets. You buy 100 shares of Coca-Cola at $61. You write the contract to sell a $61 call expiring in 3 weeks. You collect the cash immediately, right? If you collect $1.15 per share, that's $115 immediate cash. If the stock moons, right, shares gets called at $61, you keep your $115 but forfeit extra upside. Yes, that's the cap here. This is where, all right, you lose out on the growth. However, if the stock tanks, option expire worthless, you keep your 100 shares and your $115 cushion. So this is where, us Covered Call ETFs investors, this is how our money gets paid out to us. Of course, this is why strategy matters a lot. You don't want to write at the money all the time, right? You want out of the money with call spreads. Essentially, if you're doing it yourself, you create your own dividend out of thin air, right? Lowering your break-even cost basis. All right, let's look at the Volatility Risk Premium, VRP. Very important. What this means is that you're getting paid by monetizing fear, right? Premium or priced by IV, not earnings. Systematic overpayment, right? Option buyers consistently overpay out of fear of market crashes. And 3, we are the casino. We play as the house. The money isn't in buying the option. It's the money's in selling it, right? We act as the house. And over the long term, the house always wins, okay? Covered Call ETFs act as an institutional insurance, think of the house, underwriters, right? Collecting those fat fair premiums, right? You get paid fat premiums because retail fare is mathematically overpriced. For the most part, not always. All right, look at the math here, right? Basically, your paycheck is tied to mechanics, right? The statistical proof here is that Global X plotted premium income directly against the VIX. That means the R-squared correlation is insanely high. Translation, simply, when the market panics, implied volatility expands, right? That means your premium income expands proportionally, meaning your cash flow is tethered directly to market mechanics, not corporate balance sheets, okay? You will get paid. It's just a matter of how much you get paid. Yes, that does fluctuate. But as long as you can buffer yourself, build around it, right? If you need $3,000 a month to live, right, to sustain, push yourself to $5,000 a month, right? That way you have a $2,000 buffer. With dividends, you can have, look at the history of 30 years of paying out consistently. And then the 31st year, completely cut, or by the 32nd year, completely dividend pause, right? You lose that income completely. Right, the volatility trap. I talk about the good, the bad, the ugly. I talk about it all. Right, I'm not trying to be biased here. I will talk about the bad. Right, so the critics do warn that billions pouring into ETFs causes volatility compression, meaning constant option selling introduces a downward bias on the VIX. Right, this is artificially pinning the market and suppressing realized volatility. How does the premium survive? Well, VRP is structural, right? Pension funds and sovereign wealth funds have strict regulatory mandates to buy index options for downside protection, right? So this immense institutional demand guarantees the premium survives, okay? There's the rebuttal here. The structural necessity for financial insurance keeps our cash flow engine alive, okay? We're going to always have it. All right, so will my principal bleed? Another thing that critic does claim is that high yields are an illusion, right, causing NAV decay. That is true if you buy the wrong structure, right? Looking at pure dividends, out of the money partial, and 100% at the money, what do you guys see, right? You see that legacy funds like QYLD uses 100% at the money override. They absorb all of the downside and capture none of the upside, right? So this is mathematical asymmetry that causes severe long-term NAV erosion, right? Convexity drag. Your challenge right here, if you're maximizing immediate yield with 100% at the money override, this will lead to structural NAV decay. Now, depending on where you're at in life, of course, and how you're trying to play this, it could work out. All right, so how do I keep my capital and yield, right? Looking at a lot of modern option architectures that optimize capital retention over pure yield extraction. First, partial overrides. So funds like QYLG, XYLG only write options on 50% of the portfolio. That means you retain at least half of the capital appreciation while generating high yield. Second, out of the money. Funds like SPY-I, of course, I'm sure everybody knows about the SPY-I from NEOS, set strikes 2 to 5% above the market, right? So this allows the ETF to capture moderate market rallies and compound capital. And then third is a lot of people's favorite, that seems a lot of people favor on the channel, is the daily override. Right? So this harvests massive intraday data decay using daily options, right? So you avoid the 30-day lockup. There's very good, there's very bad to it, right? The strategy plays both sides, right? This allows you to participate fully in multi-week bull runs. So your pick, your persuasion here is that intelligently engineered option always optimize the trade-off to support highly sustainable total returns. Right, looking at the 4 market regimes here, we have to be honest with ourselves, right? Cover call superiority is strictly regiment dependent. If we look at the macro economics of low volatility, strong bull, dividend stocks have a strong full upside, while cover call ETFs will underperform, right? The gains are capped. High volatility and sideways, dividend stocks have moderate, maybe no growth. But cover call ETFs have a strong, massive premium here. High volatility in bear, this is where dividend stock starts to fall off. It's weak and a possible dividend cut, right? The recession. Cover call ETFs, strong yields skyrocket. And disinflation and plus QE, this is where dividend stocks will probably very strong, right? Probably moon. And cover call ETFs could, and this is where we will say we will go sideways, possibly, right? Moderate and low VIX caps yield. My statement here is please deploy these tools selectively on a macroeconomic weather. So we're starting, for us income investors starting out with cover call ETF, understand that if we're entering a sideways or a bear, this is where you dive in, you build your holdings, right? Because we're buying for the cheap, and then you can think about expanding. Like myself, what I'm going to be doing is I'm building out my current cover call holdings and then slowly expanding into dividends, right? So then I build myself around actual diverse holdings. So understand that it's not always one that's better than the other, but if you do choose a cover call ETF that have good structural strategy, I would say you might possibly even beat most dividend stocks. All right, yield during market crashes. So any bear market, cover call possess a very defensive, counter-cyclical yield characteristics. What do I mean by that? Looking at the dividend yield when it crashes is at 3.5%. This is at risk. For cover call yield for a crash, I would say this is where it starts to surge, right? It beats by 11.5% and plus and surging, right? Severe equity declines trigger violent spikes in IV. This is where we're getting our fair premium, right? So my absolute premium income mechanically increases precisely when corporate boards freeze traditional dividends. Okay, that's when they get scared and it's like, all right, we have to make cuts, we have to make layoffs, we have to, probably close up some stores, right? So volatility translation just means I get paid the most when prices drop the fastest. All right, legally keeping more money, right? Qualified dividends. It could be the old way, right? A lot of traditional dividends ETFs like SCHD distribute corporate dividends, right? So if held long enough, they are qualified and taxed at a favorable long-term capital gains, right? Anywhere from 0, depending on your income, right? All the way up to 20, right? A solid win for old school stocks. It's great. I'm not hating it. But a lot of people seem to love the Section 1256 better, right? So ETFs writing board market index options trigger a Section 1256, right? So this grants a mixed straddle rate of 60% tax long term and 40% tax short term, regardless of holding period, right? So this is a more massive after tax efficiency, right? So of course, this comes down to the decision of yourself, right? Optimally structured derivative ETF offer unique, superior after-tax characteristics. Again, of course, you can mix the both, right? I'm not saying it just depends on how you're playing your tax game. All right, let's look at the hidden bank risk, right? So actively managed giants like JEPI and JEPQ use ELNs, right? So this, of course, has its own vulnerabilities. First is the tax drag. It doesn't use Section 1256, so premiums is ordinary interest up to 37% depending on how much you make. Counterparty risk, this is where the issuing banks, they trade with banks to banks, right? This is where a 2008 style could completely crash your payout. The fix though, look, elite funds strictly cap ELN exposure to about probably 15 to 20% to prevent total fund collapse. They're smart enough. They know what they're doing, right? ELN structures are incredible yield engines, but you do have to respect the credit risk. So don't, dive in too much into JEPI and JEPQ. Understand it is great. They are very defensive. I personally will hold them in my portfolio. All right, so carrying panic and surviving decumulation. Looking at the mental accounting trap, right? We're going to review principal as sacred and yield as spendable. So if my ETF yield is 3.5%, but I need 5% to live, I am forced to sell my principal, right? Liquidating shares at a 25% discount during the crash triggers a lot of panic selling, right? The 4% rule forces your failure. And this is why I think a lot of people are going into the cover call fix. A visible 10% monthly distribution completely insulates me from a cognitive stress of pressing the sell, right? I meet my 5% withdrawal entirely in cash flow. I never have to sell principal, and I can aggressively reinvest the excessive 3% at absolute market bottoms, right? This is the clash here. And this is where I'm trying to see where living exclusively on synthetic yield drastically lowers the Monte Carlo failure probabilities. Now, I'm not saying you should own only cover call ETFs or manufactured yield. I'm not saying that. If you're looking at my portfolio, I'm currently building it where, yes, I'm only using cover call ETFs, but I do mention a lot that I am also, once I hit my goal, I will be diversifying and transitioning to different type of holdings and not just pure cover call ETFs. But understand that I think the inflow into cover call ETFs kind of shown us that, these 3.5% where dividend cuts or dividend pauses really, really hurt. Whereas distributions, right, you're going to get paid regardless. You're going to get paid. All right, so can our income beat inflation? This is one of the most important things that people don't talk about, right? Modeling. So we're going to look at a model of structural inflation averaging 3, 5, or 7% over a 20-year retirement. Looking at dividend growth CAGR, 6 to 9% and growing. Cover call yield is 10% static. So who wins here? We're going to give it to the dividend aristocrats. They do win long term. It's the math, right? High quality corporations raise prices and increase dividends, right? Cover calls don't organically grow. A static 10% yield will erode in purchasing power over 15 years. That is if you can reinvest. This is why I always say save 10 to 50% every month for taxes. If you don't use them for taxes, or there's no taxes that year for you, reinvest it. Now I don't know how much you would have, but let's just say now you have an excess of 15 grand. Reinvest. This is where you need, even in retirement, this is where you need to do this, right? The rebuttal cover call wins short-term cash flow war. The dividend growth wins the long-term inflation war. So blend the both, right? Layered capital stack, right? Cover calls don't replace growth stock. They're in an engine within my portfolio. right? Eventually, we would like to have a mix of growth sleeve 30 to 40%, volatility monetization sleeve of 20 to 30%, right? Tactical fixed income 20 to 30%, and liquidity buffer of 5 to 10, right? This architecture right here elevates yield without assuming duration risk. Eventually, I want to start diversifying and start building a more solid portfolio around myself. I'm not saying to ever go all in on one thing. That absolutely not, right? You're gonna destroy yourself, right? But we do have to destroy the haters of always saying you're just returning my capital. This is false, right? Rock is an IRS accounting pretty much a accounting, not a trick, but like actual law that they use, right? Constructive rock defers liabilities. Now, returning capital, they're mostly talking about destructive rock, where you're destroying your NAV and just returning your capital, and on top of that, getting taxed. And then the other one is options, or a zero-sum game, right? Already, if you look at academics and how people that put out papers, they refute this, right? The VRP is a negatively priced insurance premium. Option sellers are structurally compensated for providing, catastrophic insurance to institutions. That's why we get paid for this, right? Oh, but you underperform in bull markets. Maximizing total return is an accumulation goal, right? So in decumulation, my goal is surviving sequence of return and keeping my sanity. I don't always have to outperform in bull markets if my goal is to retire either as soon as possible, or when you reach your goal of 20 years and you're retiring and you're just getting paid that nice monthly cash flow, right? So here, a lot of people are going to say, I never want to touch this. I never want to, but that's fine too, right? But they're stuck on these, like, basically, destructive rock and, options are a zero-sum game. You're going to always underperform bull markets, right? Pretty much a lot of these already been refuted and disputed, right? We've given our rebuttal. There's at this point, if they want to stick with 3% yield and work for 20, 30 years, that's another option. That's okay too, right? And now I want to end with this. Fire your dividend board, right? We're not about begging for leftovers. As long as we can master the volatility game, right? Study the VIX, understand the fear, you can print your own absolute financial freedom, okay? Take control of your own income architecture today, all right? I hope this was informational. I hope for those new income investors, we get a lot of hate for, picking distribution over dividends. Oh, especially if you're young, right? Everybody has different goals. I'm in my 30s and I want to retire within the next 3 to 5 years, right? 5 years maximum, right? I definitely want to retire myself before 40, right? So if you're on the same goal, please leave a subscribe, leave a like, leave a comment. I hope this was a little bit informational, creative, fun. I hope you got something out of it, but I felt like I do have to make this because we do have to understand the difference between distributions and dividends, and which one you could pick and start, over the long term, how you want to build your portfolio over. So thanks for watching, guys. Stay tuned. Catch you guys on the next.